I absolutely am convinced that the crisis that started with Silicon Valley Bank last March is just the first warning shot. In my last video, I showed you that there is potentially big trouble brewing in China that could spill over into the rest of the global economy. But it isn't just China. The entire global economy is already sick. Today, we're going to take a look at a little bit of what is wrong in the US, and then we're going to finish up with a piece that I forgot to tell you about in my last video about China. And it is a very, very important, potentially the most important piece of that video. First, we're going to visit something I haven't covered in a long time, the U.S. National Debt Clock. So it's usdebtclock.org. And, I covered this back, I've been covering this for years. This existed back when I was writing my first book. So back in 2008, that was published. So 2005, 6, and 7, I was looking at this U.S. debt clock, and I've covered it periodically, but it's been quite a number of years since I've said anything about it. And as a lot of us already know, the U.S. national debt is now over $33 trillion. But what you don't know is that if you pay taxes, if you're working and paying taxes, the average tax owed per taxpayer is now over $250,000. So you owe you owe $255,000 in taxes. Now, that is what we owe over the average duration of all of the U.S. treasuries that are outstanding. Now, the average duration, the rollover, the refinancing, and this is going to become very important in a few moments. The average refinancing used to be about 4.5 years. I believe it is closer to 5.5 years now. But 5.5 years is 66 months. And I do think that that's generous, because there was a little while where Alan Greenspan, during his reign, we had eliminated the 30-year treasury. So the duration should have gotten shorter, not longer, for the average. But the average is the mixture of all the bonds that come due in 30 days to 2 years. That's the bills, not bonds. Then the notes that are 2 years to 10 years, and then the bonds that are 10 to 20 years. So anyway, getting back to this, 33 trillion, but there's a whole bunch of very interesting things here and stuff that has gone crazy lately. When I covered this originally, all of the numbers were sort of going in the same direction, but now a bunch of these numbers have reversed. You've got things that are just completely unsustainable. They're, if the currency supply is shrinking, but the debt is going up, there's something wrong here. And so if we start taking a look at some of this breakdown here, we've got the tax revenues. Look at how these are falling, not going up. 7, 6, 5, 4. So this is $100,000. There's hundreds, thousands, and now we just rolled over $1 million of lost tax revenue in that period of time. Meanwhile, look at how the debt is increasing. The numbers are ticking at about the same rate, but in the opposite direction. This is definitely not sustainable. The U.S. total interest paid, the U.S. total debt. So this debt includes private debt here. So it's over $100 trillion. This does not include unfunded liabilities. This is, U.S. total debt includes household, business, state, local governments, financial institutions, and the federal government. Or that should have said non-financial. It says financial institutions. Financial institutions are normally excluded because they have to carry debt as an asset. And so I believe that this is actually wrong. This would be non-financial institutions, because that lines up with about what is true. Anyway, the revenue per citizen is $12,000. It's about $13,000 against the average. That's per citizen against the average taxpayer, or owing $250,000. These things just don't add up. And then we've got state debt down here, local debt, and so when you add all of this together, there's nothing sustainable here, and all of these numbers are just going in very divergent directions. Look at the rate that the M2 currency supply is falling. You sit here and look at this countdown of 1, 0, and this is the next number will roll over soon. There we go. So that was $1 million bucks of the U.S. currency supply vanishing. Why? People aren't borrowing as much into existence. When you look at the total debt, it's going up, but personal debt is increasing. Credit card debt, though, is falling. 6, 5, it's going down. Everything has gone haywire. Student loans are going up. And these numbers are just rolling over at these incredible rates. This is worth going to and just try and absorb it. Sit there for 20 minutes or so and just put your cursor over things, and you'll notice that up at the top here where it says usdebt.org, a lot of these boxes have a definition of what this box means. And it's all bad news. Now, I want to show you some of the impact that this will have on us. So this is from the Government Accountability the Government Accountability Office. So are they really accountable for anything? I don't think so. But this is an interesting article, and I want to point out some of the breakdown here. This is for fiscal year 2020. Now, at the beginning of 2020, we had $23 trillion of debt. At the beginning of 2021, we hit $28 trillion. This is the fiscal year, the final quarter of 2020, which was at $27 trillion. So this was at 28 by the 1 year from the beginning of 2020, where it was only at 20. So it jumped from here to here in just 1 year. Now, take a look at this breakdown. You've got debt held by government accounts, $6 trillion. We're going to go to an article next that shows that as non-marketable securities. These treasuries are a type of U.S. treasury that you and I can't buy. They're not bought and sold on exchanges. They're only traded within the government. And so it's a special IOU. Who holds those? Well, 49% is held by Social Security. Social Security is our retirement accounts and disabilities. So it's our retirement trust. It's supposed to be I love these words. It's a trust. We got to trust them that they're going to be able to tax people in the future to a rate where you can live off of somebody else in the future. And there's got to be enough of those people making enough to be able to tax you, to tax them at a rate to be able to give you what you have been promised. And we pay into this Ponzi scheme all of our lives. But there's nothing there. They've borrowed it all and they've spent it. So that's both our retirement accounts and disability. That's where that comes from. And then you have Medicare, which is healthcare over here. So add that. So retirement, healthcare, disability. Add those all together, and that is 53% already. However, military retirement and healthcare is the same thing for military. So that's for veterans and the active military. And so you can add that 20% into healthcare and retirement for U.S. citizens. And then you've got civil service retirement and disability. And so you can add this 16% into. So you've got everything here except for this 11% that's other. that is accounted for as health care and retirement, basically. And this is what most of the population in the United States is relying on, and it's nothing but IOUs from future taxation. It currently stands at $6 trillion. We are in some really big trouble. Now, debt held by the public, 21 trillion. So this, all of this is what the politicians decide that they're going to spend willy-nilly. And now we've got this Inflation Reduction Act, and they at first, they froze the national debt, and we ran into the debt ceiling, and then they suspended the debt ceiling, so it's gone again. And they passed the Inflation Reduction Act, $6 trillion, and now we've got the threat of shutting down the government again, and this dog and pony show that keeps on repeating. And it's usually with a major election cycle. It's just stuff to keep you distracted. Look at that national debt clock and just pay attention to the big picture, not who's trying to shut down the government or who's trying to spend the most. Just look at the big picture of how it all comes together. But in this debt held by the public, we've got domestic investors, international investors, and the Federal Reserve. Federal Reserve used to be the tiniest little sliver, and now it's 21%. And I want to point out that these people produce something. The domestic investors also produce something. It's called our GDP. They create the economy. There's the international investors. They also produce something. And for us in the U.S., this ends up as international trade. We buy stuff from these people that are also holding our debt. And then there's the Federal Reserve, which produces nothing but slavery. So because we all have to pay taxes in the future for this amount of our debt that they have bought. They buy this up, these U.S. treasuries and mortgage-backed securities, by counterfeiting. There's no work involved. The difference between 1 and 1 trillion is just what 12 more zeros, I believe it is. It's been a while since I've said that quote. Hi, I just wanted to take a moment and thank you for subscribing, and mention that if you'd like to help our channel, please consider my company, GoldSilver.com, the next time you buy precious metals. We're one of the most trusted names in the industry. Our prices are sharp, delivery is fast, and we have an insiders program where you find out exactly what I'm doing with my own investments. Thanks for making GoldSilver.com your dealer, and now back to the video. In which countries are the most treasuries securities held? Well, for some reason, they aren't including in this graphic, they're not including the U.S. here. But $1 trillion to 1.3 trillion. China and Japan both hold that amount. And then we've got a couple of countries here that hold somewhere between 200 billion and $1 trillion, and then everybody else, basically. Moving on. So this is from the Federal Reserve Bank of St. Louis Economic Research, assessing the cost of rolling over government debt. And this is a pretty good read, actually, although on all of these different articles that are done by the government, they are chronically underestimating things. This says, assessing costs of rolling over government debt. In the span of about 1 year, the Federal Reserve Open Market Committee has raised the federal funds target rate from 0 to around 5%. You'll see that it's 5.33. Is the effective. There's the difference between the target rate that you hear about when you hear about the FOMC meetings and a rate increase, and what the actual rate is, because it's sort of floating in a band that they're trying to keep it in. This has driven up other rates, mortgages, U.S. treasuries, bank loans, etc. Given the high speed at which rates have risen, and I have been, since they started these rate increases, that's something that I've been reporting on, is the incredible year-over-year change in rates. There's never been a time in history where rates have gone up this much, this fast. There have been times when it's gone up this much this fast, not in a year over year, but in absolute terms, when it was going from 14 to 19%, for instance. But you're starting at a base from 14. So the change is not that great. When you're starting from a base that's 0.1 or less, then anything is huge. There are concerns about the cost of rolling over existing debt for firms, households, and governments. Specifically, when debt matures, issuers must decide whether to roll over the debt by issuing new debt at the current rate or find other resources to repay the debt. Take, for example, a small business owner who, in 2020, at the beginning of the COVID-19 crisis, borrowed at 3% interest rates with a three-year maturity. And so that's a lot of businesses and stuff. The 3-year maturity would be like business loans. This year, when the owner returns to the bank to discuss the rollover of the loan, they will likely be quoted a rate that is double to triple the existing rate. This creates a difficult choice for the business owner: maintain the same amount of debt and pay double or triple in interest, or reduce the level of debt and cut costs. How do you cut costs? Well, usually that means layoffs. Cutting costs is layoffs, and then reducing. You don't want to refinance equipment and buildings. You're trying to pay that off. So what you got to do is liquidate inventory. You've got to lay off people. You may have to sell a building. You've got to shrink the size of your business. And that means shrinking GDP. How does that feed into the tax revenues on that U.S. national debt clock, which are already falling while the debt is going up? We're in for this. The whole world is in really deep. And I'm going to get back to China in a little while. This trade-off applies to any debt issuers, e.g. the U.S. government. In the fourth quarter, the total public debt, according to the U.S. Treasury Department, was just over $31.4 trillion. Well, we now know that it's over $33 trillion. But here's the breakdown of the debt. Remember, we talked about those U.S. Government-owned debt. Well, that's these non-marketable securities. Notice that we've got total debt here, and then it branches into marketable and non-marketable, and it's almost 24%, almost a quarter of the U.S. debt is held by these agencies like Social Security and Medicare. And it's non-marketable, and then that doesn't branch off into anything. So that's just the 24%. Then you've got marketable. You've got a little bit, 8% variable rates, but the vast majority is this fixed rate. So you've got the bills up to a little less than 2 years, notes and bonds. A lot of this is 30-day. So almost 12%, and this is a little over 12%. So these two almost cancel each other out as far as long-term versus short-term, and it brings it into medium. This is 2, 3, 5, 7, and 10-year notes. And so the average of all of this is around 5 to 5.5 years. 5.5 years is 66 months. And so we're going to do a little bit of an exercise here. This shows you the type of rollover. When you add the stuff that is due in a year or less, that's like half of it. And then you've got the 2-year, the 3-year, 5-year, 7-year, 10-year, 20-year, and 30-year here. So next year, there will be a blue line. The stuff that is due in 30 days is not in next year. They're issuing that right now at these much higher rates, which you will see is very, very important. So you can take a blue line like this and stack that underneath this one. Every year, this will happen where there's this big blue line. That's what has to be refinanced. And then you don't need to go through any of these other formulas. The rest of the article is not that important. What I want to show you here's the total debt as of Q2 of 2023, except when you calculate the rate of spending, it is higher. It's now at 33 trillion. And then, and this was during where they had run into the debt ceiling. And what they do when they run into the debt ceiling is, you may, for a little while, all they do is shuffle stuff. And so they're still spending. They're still going deeper in debt. They just don't show it to you. It's a lie. Whenever they run into the debt ceiling and you see the national debt go level and they're still spending, they're lying. That's all. That's all it comes down to. And so we're at 33 trillion, and you can see this huge jump here during the pandemic. We were at Q1 of 2020, 23 trillion. Q1 of 2021, 28 trillion. And now we've created this $6 trillion spending package. And on top of all of this, there's going to be another crisis. And the spending, when this other leg, the global financial crisis of 2008, back in here, played out as first Northern Rock in England, and then there was like a 1-year pause, and then there was countrywide, and then there was 5 months, and then there was Bear Stearns, and then there was, I can't remember exactly, but I've done videos on this, but it was like a year, and then 5 months, and 6 months, and 5 months, and then 3 months, and then bam, 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 it was coming every single week. And so I absolutely am convinced that the crisis that started with Silicon Valley Bank last March is just the first warning shot. And if you look at the scale between Silicon Valley and Signature and First Republic, this was huge. And then in those, we don't even show the Credit Suisse crisis because that got merged into UBS. So it's like they papered it over. But if Credit Suisse had actually gone under, that would have dwarfed everything else by a long shot. So the crisis that we just had in March was absolutely enormous for the first leg of a multi-leg crisis. There's going to be waves to this thing. So here is the federal funds rate. And, this looks like it's rolling over and slowing down. And it'll level off like it did back here and back here. It'll level off. And then there will be another crisis, and they have to drop it down to zero. But my point with this is, take a look at this century. We have the 30-day to 1 year, and then we've got 2, 3, 5, 7, 10, and then there's a 15, a 20, and a 30 year bond. And so you've got to look at this century. If you go 20 years ago, the 20-year bond, you're talking about 1% was the federal funds rate. And so the majority of all this debt that was issued, there's a few years here where it was issued at rates as high as we're at right now. But most of the vast majority, 0.9, 0.8, 0.09, 0.07. There's 1 month in here of 0.04. Now, that's not the Treasury debt. That's the Fed funds rate. But this affects the Treasury rate quite a bit. So the average here is probably less than 1%. Now, if you look at the interest on the federal debt, it has exploded from 600 billion, and as of Q2 of 2023, it was at 900. I'm going to round 970 billion, and so by now it is probably over $1 trillion. Now, if you take the amount that is being rolled over each month, if you take 33 trillion and you divide that by 66 months, which is 5.5 years, is 66 months, you end up with $500 billion, 500 billion every single month that has to be refinanced. Calculate that at the new rates that the government has to pay. And this is not, this looks, I'm going to shorten up the time span here. this looks like it's slowing down. You have these huge leaps that were happening so we've got Q2 to Q3 of 22, Q3 to Q4, there's huge leaps. And then this last leap looks like it's much smaller. But you've got to realize that you're taking the national debt and you're refinancing it at these higher rates. And then every month you stack another $500 billion of refinanced rates on top of what you just refinanced. And these things keep on stacking up at this higher rate. So it's not a pretty picture. Now, in the last video, I went over some of the bullish signs that gold was at. I pointed out that we've got this big cup and handle, which is turning into a pan and handle, like a pot on the stove that has sort of a longer handle. And with that, we've also got a triple top. And with that, we also have an inverse head and shoulders building right now, and it could break out any moment, and it would be a valid inverse head and shoulders, but it would be even better if it does a little bit more of a pullback. I know people hate me when I say that I wish gold would fall a little while. It just gives me a chance to accumulate a little bit more before the next crisis, and I think the next crisis is going to be enormous. And all of this evidence, put it together with last week, or my last video yesterday, put it together with that. Rewatch that if you need to, and then watch this video again and see how all of this is converging. And it's not just China, it's everywhere around the world. And so if this makes a little bit more of a head and shoulders, I would be pleased, because personally, I think that whatever is happening is going to be an absolute catastrophic disaster. I guess that's a little bit redundant, isn't it? Catastrophic disaster. But it's going to be really big. And the stored up energy from papering over every problem that we've ever had ever since, I mean, we had the ability of totally papering over every disaster since we went on to off of the Bretton Woods system and onto the US dollar standard. And then with the techniques that Ben Bernanke introduced, Bernankenomics, when he wrote that paper back in 2002, deflation, making sure it doesn't happen here. And watch my video about decoding Fed speak. When he wrote that paper and introduced all of these different things that they could do once they reached the zero bound, he said they're not out of ammunition. That changed economics fundamentally. And so I would love to just see this build a little bit more, give us a little bit more time before all hell breaks loose. However, it is breaking loose, and getting back to the premiums paid on the Shanghai exchange, I'm going to enlarge this a little bit. So I showed this in yesterday's video, and people are paying 4% to 6% over the global spot price to get gold on the Shanghai exchange. Why would this be exploding? Well, it's because people are asking for delivery, and that they're paying this much more for contracts now because there's less on the exchange. These higher prices then cause people to buy gold in New York and London and Hong Kong and Singapore, and actually ship physical gold to the Shanghai exchange because there's an arbitrage opportunity. There's a profit in it. But what I didn't point out, that is probably the most important thing in this chart, is that when you go back to the U.S. chart, you have a previous high back in 2011, and then you have a little bit higher high that didn't quite reach $2,100 back in late 2020. And this triple top that has built, but they've managed to keep this under that previous high. When gold is setting record highs, it gets into the news cycle. And what happens is something called, it becomes a Giffen good. If you don't know what that is, you need to get my book, which will be available again in a week or two. It's currently unavailable. It'll be back up on Amazon very soon. We're working on that right now. I explain that in Chapter 7, the difference between the 70s bull market and today. And there's a section called The Gift of Giffen. And you really need to read that to understand the psychology of what happens when gold goes into an uninterrupted bull market of setting brand new record highs. Well, here we have this triple top and it's below its high. But look at what has happened in China. Gold is setting record all-time prices, and unless somehow the government is keeping that out of the news cycle and there's no rumors going on that gold is setting record highs, yet people can actually buy it if they pay a record price, how could this not be a rumor? I mean, even if the government is trying to suppress the fact that gold is setting record prices in China, what happens when it's in the news cycle and people find out that gold is rising is it continues to rise. That's what a Giffen good is. It's something that violates the fundamental laws of supply and demand. And as the price rises, instead of attracting fewer buyers, it attracts more buyers, sometimes in a panic. So get ready sometime over the next few years, and it could be next month. All hell is going to break loose. I want to thank you for watching. If you got anything from this and you're going to purchase gold or silver, please consider my company. It's what funds me being able to do all of this. Thank you for watching. We'll see you next time. Hi, I just wanted to tell you about GoldSilver's 111-ounce silver giveaway, where you can win 111. One 1-ounce silver bar, one 10-ounce silver bar, and one 100-ounce silver bar. So enter today and win.